Market crashes are a terrifying and inevitable part of investing. As experienced investors know, financial markets are inherently volatile. While this can result in substantial gains during bull markets, it also means inevitable downturns during bear markets. However, one of the key elements of successfully surviving a market crash isn't about predicting when it will happen, but rather understanding the psychology behind these events and how to react to them. In this piece, we explore the complex psychological dynamics during market crashes, offering strategies to not only survive but thrive during these tumultuous times. Understanding market crashes. Before diving into the psychology behind market crashes, it's essential to define what a market crash is. Simply put, a market crash refers to a sudden and severe decline in asset prices, particularly in stock markets. These declines are often accompanied by widespread panic selling, as investors attempt to cut their losses in a rapidly deteriorating environment. A market crash can be triggered by various factors, including economic shocks, corporate bankruptcies, geopolitical instability, or even shifts in market sentiment. Although market crashes are often unpredictable, their psychological impact on investors is generally consistent. Crashes evoke a range of emotions, such as fear, anxiety, and regret, which can lead to irrational decision-making. This emotional volatility is precisely what makes market crashes so dangerous for investors who lack the psychological resilience and strategic foresight to navigate them effectively. The role of fear in market crashes. Fear is perhaps the most prevalent and powerful emotion during a market crash. As prices plummet, fear takes hold of investors, leading them to make impulsive decisions driven by panic rather than rational thought. The fear of further losses can quickly transform into a self-fulfilling prophecy, as widespread selling further exacerbates market declines. This fear-induced selling creates a negative feedback loop, where the more people sell, the more prices fall, leading to even more panic. A significant part of the fear experienced during a market crash is driven by uncertainty. Investors are uncertain about when the market will hit rock bottom, and even more uncertain about when recovery will occur. As a result, many investors tend to act out of fear rather than sticking to their long-term strategy. This panic often leads to selling low during the crash, only to regret not staying invested when the market eventually rebounds. The key to surviving a market crash lies in managing this fear effectively. Instead of succumbing to panic, investors must learn how to detach their emotions from their decision-making processes. By cultivating a long-term mindset and understanding that market crashes are temporary, investors can avoid making emotionally driven decisions that could undermine their portfolios. The impact of herd mentality. Another psychological phenomenon that plays a critical role in market crashes is the herd mentality. In times of uncertainty, humans have an innate tendency to follow the crowd. This is particularly evident during market crashes, where the actions of a few panic-stricken investors can trigger mass selling. As asset prices continue to fall, the fear of missing out on cutting losses drives even more investors to follow suit. This creates a domino effect, where panic spreads across the market like wildfire. The herd mentality is dangerous because it leads to the amplification of market movements, both to the downside and the upside. During market crashes, the fear of being left behind or losing out can lead investors to make rash decisions. However, it's important to remember that not all crashes are the same. While the herd mentality can exacerbate short-term declines, long-term investors who remain calm and stick to their strategy often emerge stronger. To counter the herd mentality, investors must remain focused on their long-term goals and avoid being swayed by the actions of others. This requires discipline, patience, and the ability to block out short-term noise. Understanding that markets will inevitably recover in the long run can help investors make more rational decisions during periods of panic. The fear of missing out, FOMO, and regret. During a market crash, the fear of missing out, FOMO, can also influence investor behavior. For those who are sitting on the sidelines and watching the market drop, there is a constant fear that the market might recover quickly, leaving them behind. This fear can lead investors to enter the market too soon, often in an attempt to catch the bottom of the market. While it's impossible to time the market with accuracy, FOMO can cause investors to take on more risk than they are comfortable with, often resulting in poor decisions. Regret is another powerful emotion that comes into play during a market crash. Many investors experience regret after the fact, particularly if they sold their positions during the downturn and missed the subsequent recovery. Regret can lead to hindsight bias, where investors convince themselves that they should have made different decisions. However, this type of thinking is counterproductive and can often result in overcorrection, where investors try to make up for past mistakes by taking excessive risks in the future. To mitigate the impact of FOMO and regret, investors must adopt a disciplined approach to investing. Establishing clear investment goals and adhering to a well-defined strategy can provide the emotional fortitude needed to weather the storm. Additionally, accepting that mistakes will happen is part of investing. What matters is the ability to learn from those mistakes and avoid repeating them. The importance of diversification. One of the most important strategies to reduce the psychological impact of market crashes is diversification. By spreading investments across a wide range of asset classes, sectors, and geographical regions, investors can mitigate the risks associated with a crash. Diversification helps ensure that a downturn in one area of the market won't have a devastating impact on the entire portfolio. During market crashes, investors often panic because they see the value of their holdings decline significantly. However, those who have diversified their portfolios will often experience less volatility overall. For example, while stocks may be falling, bonds or real estate investments might hold their value or even increase during the same period. This balance can help reduce fear and anxiety, as investors can take comfort in the knowledge that not all of their investments are exposed to the same risks. While diversification does not eliminate risk, it can help smooth out the emotional roller coaster of market crashes. By maintaining a diversified portfolio, investors are better positioned to ride out the storm and recover more quickly when the market rebounds. Maintaining a long-term perspective. Perhaps the most effective way to thrive during a market crash is to maintain a long-term perspective. The biggest mistake investors can make during a downturn is to focus too heavily on short-term fluctuations in the market. While market crashes can be unsettling, history has shown that markets tend to recover over time. By staying focused on long-term objectives, investors can avoid the emotional traps that cause them to make poor decisions during a downturn. Successful investors know that volatility is a natural part of the market cycle. Rather than panicking during a crash, they view it as an opportunity to buy high-quality assets at a discount. If you've done your research and invested in fundamentally strong companies or assets, the short-term fluctuations in their value should not concern you. In fact, a market crash can be a prime opportunity to accumulate more shares at lower prices, positioning yourself for greater gains when the market eventually recovers. Maintaining a long-term perspective also requires patience. It's easy to become discouraged when the market is down, but patience is one of the most valuable traits an investor can possess. Understanding that market crashes are temporary and that recovery is inevitable will help you stay the course and avoid making impulsive decisions. Developing mental resilience. The final piece of the puzzle in surviving and thriving during a market crash is developing mental resilience. Market crashes test an investor's ability to remain calm, rational, and strategic in the face of overwhelming uncertainty. This mental fortitude is what separates successful investors from those who succumb to fear and panic. Mental resilience can be developed through practice. By establishing a set of rules or principles for how you will react during a market crash, you can prepare yourself mentally for the challenges ahead. This might include setting stop-loss orders to limit potential losses, diversifying your portfolio to reduce risk, and establishing clear investment goals that you can fall back on when emotions are running high. In addition, it's crucial to learn from past crashes. Reflecting on previous market downturns and how you responded can help you identify patterns in your behavior and make adjustments for future crashes. Over time, you'll develop the emotional resilience needed to navigate market crashes with confidence. Conclusion. Market crashes are an inevitable part of investing, but they don't have to be the end of the world. By understanding the psychology behind these events and developing a strategic approach to managing fear, uncertainty, and panic, investors can not only survive but thrive during market downturns. Diversification, a long-term perspective, and mental resilience are key components of a successful strategy for navigating crashes. While it's impossible to predict when the next market crash will occur, the best thing investors can do is prepare themselves emotionally and strategically for the inevitable. By maintaining discipline, avoiding emotional decision-making, and focusing on the long term, investors can emerge from market crashes with their portfolios intact, and perhaps even stronger than before.